Good morning, everybody, and welcome to the Pavilion. It's really fantastic to be able to welcome everybody back, which seems like such a long time since we've actually done one of these, and I think it's been about 3 years since we've done one, so it's been far too long, really. So there's certainly been a real buzz in the office over the last couple of weeks while we've been preparing to get this ready. For the first time this morning, we've actually got this live on YouTube as well, which is a first for us, and it's good to be able to sort of bring it to people in different mediums, and which wouldn't normally be able to sort of make it here this morning. So moving on to the agenda for this morning, Richard is going to start by going through the main points of Wednesday's budget and picking out really how that's going to affect us in reality as we navigate our way out of COVID. And then I'm happy to introduce Luke Pearce. Luke Pearce is from Rowan Dartington, who's our discretionary management side of St James's Place. And Luke's going to be talking about how it is to invest in uncertain times, which I think will be very useful in judging the last sort of 18 months that we've been through. So at the end of the two presentations this morning, there will be a question and answer session. So we'll be able to answer any general questions that anybody may have. We're not going to use microphones this morning, so don't worry. But we will just sort of shout out the question again so everybody can hear it. Okay, so I hope you enjoy this morning, and I now hand over to Richard and we'll get started. All right, thank you.
Just wonderful to see you all in person rather than that wretched Zoom thing or whatever. And anyone watching on that makes me very nervous, that camera. So if I stutter a bit or whatever, it's because I'm looking at a camera as well, for those that aren't here but want to see us. We sent these out yesterday, so if GPO works, we've had rather hit and miss with the post, but everyone will get the budget report. If it's not today, tomorrow. And in your on your laps, as always, underneath the agenda, there is what we call the taxation questions and action list, which I will refer to as we go through this and go through. Now, interestingly, when I did the presentation, having looked obviously at the presentation in March, virtually nothing has changed on the face of it. So from a taxation point of view, the word tax was hardly used in the budget, and so there isn't a huge amount for you to do. But the sequence of travel and where everything is going is very relevant. The burden of taxation is clearly rising and will be at its highest level since the 1950s. Spending will be at its highest level since the 1970s. So you do have a Conservative government in power, but they are behaving in a very different way, perhaps, to the Conservative governments that you would have known under Maggie and then John Major. So let's have a look at something, firstly, that was not in the budget. The bad news seems to have been well announced a long way in advance when many people were on holiday, and that is national insurance is going to go up from April of 2022 by 1.25%. That only affects you if you work. It will mean that pensioners for the first time that still are in employment will pay national insurance, but you will not pay national insurance on your pensions or the state pension, only if you have employment. You will, and I will touch on it later, have an increase in the dividend tax, but I'll deal with that later. Now, this was dressed up as a health and social care tax. It was giving a cap on the amount that people will pay in care, and we will spend some time on this next year because the detail is still unclear, but it aims to give those that have to pay a fortune in care a release by capping the amount that you pay to £86,000. But that does not include accommodation and food costs. So I know very well from my father being in the Granby for 3 years, one, he outstayed everyone else from 94 to his 97th birthday. but the care, the accommodation and the food costs are actually about half, if not more, the total cost. The average expectation when you can't wash yourself, dress yourself and feed yourself in a nursing home, or if you're at home, it is about 18 months. So how many people will actually pay more than 86,000 is a moot point, particularly with the sort of standards of care up to going into a nursing home now slowly improving. So this is a thing that wasn't in the budget. It's going to affect all of your children and grandchildren at work. They are going to be paying more national insurance. Every working age person who receives income will be worse off from April 22 before we even look at mortgage rates. So the rest of it is relatively simple till we get to the dividend tax. Everything is frozen for the next 5 years till April 26. Guess what? We'll probably have an election before then. Guess what? We may see something change. And when you look at the figures, there's a lot of front-end release going on with spending, but there is a war chest that many believe it can be built up if things go roughly the way the government anticipates, and before possibly a general election, maybe out at 2024, who's to say we won't be standing up and saying what a generous government there is, they've done this and that with regard to tax. The marriage allowance, many of you know, if you are married and one of you is a non-taxpayer, you can transfer some of your unused allowance. Most of you have done that. I'm not sure all your friends have done it. There are a lot of people we meet for the first time but are not aware of this. It can save you quite a bit of tax, and you can go back quite a few years. The higher rate of tax is remaining the same, just over £50,270 to be precise. There are, I think, and I've got to get this right, I'm going to take my specs off very well. In 1991, 1 in 26 people were higher rate taxpayers. By April 26, it is anticipated that 1 in 9 will be higher rate taxpayers. This is called fiscal drag. It's where there is no apparent increase in taxation, but as hopefully your pensions, your income, the state pension all rise, you pay more tax. And it will generate substantial monies for the government in the next cycle, along with national insurance increases. The increase I'm not dwelling on is corporation tax, which goes up to 25%, a big increase from April 23. So there are significant tax rises in the pipeline. Very interestingly, not particularly targeted at the element of the population that is key to winning an election, called the retired vote, who I am proud to be talking to today. The savings tax is zero, where you have interest if your income doesn't go over the 12,570. So you can actually earn quite a bit of interest dependent on your personal income. And then your personal tax allowance for interest remains at £1,000 if you are a basic rate taxpayer, and £500 if you're a higher rate taxpayer. So on top of whatever your income is, tax is paid on your pensions, you can then earn a bit of money without paying tax on your interest. Now, a little note on this. What's been happening is your pay-as-you-earn coding notice, often coming through in the beginning of the calendar year, occasionally may have a guess as to the interest that you have earned and therefore how your code is amended. Watch that very carefully, because it's historical, and everyone I have seen is showing that the client is earning a lot more interest or assumed than they are actually earning. So how do they police it? How do you watch it? Ultimately, you may have to fill a self-assessment form in, but watch that pay-as-you-earn coding. In addition to interest, dividends also have their own allowance. It was £5,000. It's dropped to £2,000 per person, and that rate has gone up by 1.25%. Again, not announced in the budget, but pre-announced in September, so that instead of basic rate taxpayers paying 7.5%, you're now paying 8.75%. And on your checklist, I've already gone down a couple of those things. Do write down, are you using that dividend allowance? As I say, the burden of tax is going up. Your incomes with pensions hopefully will rise. And therefore, it's important to check that you are using as many of these allowances as I indicated. So watch that. Watch the pay-as-you-earn coding. We still have the wonderful Brian Mason that does a number of your tax returns, former Inland Revenue Tax Inspector, poacher turned gamekeeper. It's very, very cost effective. It can help if you need to do so and if you need to watch what you're paying. So how do you reduce or minimize? And there's no rocket science, and I'm not going to take an overly long period of time. But firstly, the ISA allowance. A few of you asked, will they keep allowing us to put £40,000 per couple offshore effectively into a tax-friendly environment in the ISA? Yes, that is confirmed. It will remain at £20,000. Hasn't moved for about 5 years, but £40,000 per couple still, to me, seems a lot of money. And for goodness sake, as most of you do, make sure you do your ISA as early as you can in the tax year. Really, they become the bedrock of normal wealth management in that the first one of you to die, the spouse can inherit and retain the tax-exempt status of the ISA. Sadly, we've done too many of these in the last 18 months, and it's a very quick process post-probate without any cost to transfer the ownership of a deceased ISA whilst retaining the ISA status into the name of the survivor without any form of cost. And that allows the survivor, I call it, to have a store of wealth that will never be taxed on income tax and capital gains tax again. It is part of your estate for inheritance tax, but because of the liquidity and flexibility, you can do what you wish to do with it. So do look at them as a bedrock of what you need to look at. Maybe look at lifetime ISAs for the younger generation where you get a bit of help, but they are remaining unpopular amongst institutions like ourselves because they're either a short-term vehicle to help pay a deposit or a long-term vehicle which you can't get at till 60 to help with a pension. And normally short and long-term vehicles don't really go together. So have a look at that. I'll just go back. One aspect that really you must watch is cash ISAs. I was fully supportive of people sheltering money, particularly when you could get interest rates of 5 or 6%. Cash ISAs unilaterally seem to be giving you a lower rate of interest than you can get on the main market. And if we agree that you're going to hold your wealth in ISAs pretty much to the last death of you, you've got a reasonable period of time. So cash ISA transfers on maturity have been prevalent amongst many of you, and I would recommend them for the rest of you. Junior ISAs up to £9,000, child trust transfers, but again, I'm the horrible parent that didn't put one penny into a junior ISA for my children, all now over 18, none of them here today, thankfully, because I just didn't want them to get a big lump when they got to 18. And they are all over 18. I look and I think I made the right decision. I've got lovely children, but we are in our industry now much more bound to transfer assets like junior ISAs into the name of the survivor, and they do, sorry, not the survivor, of the young adult, and they do have to sign something. So even mum or dad quickly says, put it, a teenager at 18 maybe wants to know what they're signing and wants to know what happens with it. We got a lot of feedback about this after our Zoom budget in March of this year. Every one of you who's under 75 can put money into a pension. You can put £2,880 in. The government will put £720 in, and it is immediately exempt from inheritance tax. That rule continues. So that on the death of the pension holder, if they die before 75, the entire pot is tax-free to the beneficiary, both in receipt of the capital and in taking income out. And if you die after 75 as a pension holder, the capital transfer is free of inheritance tax, no probate needed. Always we're doing the pension way ahead of anything else in the estate. But once the recipient receives the pension fund, then they pay their marginal rate of tax coming out. So for a affluent couple maybe taking retirement at 60 with no future earned income, it may well be very prudent, dependent upon objectives, to keep putting 2,880 into a pension with no intention of ever touching it, because it is immediately exempt from inheritance tax. The other thing, and this is the other side of me, my children do have pensions. I've looked at many of you funding your grandchildren's pensions for many years. I didn't start till I felt reasonably comfortable, and my children were maybe mid-teens. And even with a relatively late start, £40,000 per child now. I haven't told them yet. Don't quite know when I will and how it will go down. But as a means of distributing wealth, but not changing the child, but knowing at least when they get to retirement age, some of the bills will be met. I think it's a fantastic way of passing wealth on. You may feel they need benefit now, and certainly with university fees and then with house purchase, you've got to get it all lined up. But I think pension provision for younger people is something that's very sensible. The only other thing I want to mention is the allowances haven't changed. The lifetime allowance, which is a real confusion, is still there. Carry forward is allowed. And obviously for working people, there's some fairly complex legislation which we'd be delighted to help with. So summary of the means by which you continue to mitigate, and on your checklist, nothing fantastic. I've not touched on premium bonds. I remain a fan of premium bonds. I monitor them personally for myself, my wife, and many clients that have it. With interest rates being so abysmal elsewhere, I think an amount in premium bonds is sensible. I wouldn't have under 20 or 30,000, and I can refer you to some articles which look at statistics and odds. The draw level is 1%, so it's better than most other things at the moment, and who knows, you could do quite nicely out of it. VCTs, EISs, venture capital trusts, enterprise investment schemes carry attractive tax reliefs, but have very high charges and are incredibly volatile. Good maybe for business owners selling and rolling over capital gains, not really the number one thing for many clients. And I mentioned growth, not income. I'll come on to capital gains tax in a minute, but make sure, and I'm sure you are using all of these, the marriage allowance, the zero starting rate, the personal savings, that's £1,000 of basic rates, the dividend allowance at 2,000, ISAs, pensions, etc., etc. And if you don't use them, you lose them. And this is our Yorkshire offshore tax account, 203,760. If you haven't done any of this before or up to and then just into the new tax year, that's the amount of money that you could put into these areas, all of which immediately becomes tax exempt. I always put that up as a challenge. Clearly, if you've done your premium bonds and other things, it's not that total, but it just highlights how much you can quite legitimately and legally hide from the tax man. So capital gains tax, I talked briefly about growth, not income. I'll refer to that again very shortly. The exemption remains at 12,300. The only very minor change at the bottom, if you are a second property owner, you had to pay your capital gains tax at the higher rate of 18 and 28% within 30 days. That's been extended by another 30 days to 60 days. So they're going very interesting. There's been a study out. The Office of Tax Simplification have recommended change both to capital gains tax and inheritance tax. Russia's ignored them both. So everything is the same, but the key rates are frozen. But are you utilizing this? I see many people with buy-to-lets, with pensions, but no one's using capital gains tax exemption. A portfolio of shares, either we've owned darted in ourselves, we actively manage for capital gains tax so that you can bed and breakfast, raise your datum points, and pay no tax for a married couple on gains of £24,600 per year. It's a lot of money when you add that to your personal allowance. And we had a lot of people voluntarily paying a bit of capital gains tax at the end of last year because of big rumours it was going to go up. It was 20 and 40% under Brown and Blair. You can easily see capital gains tax being increased, and that's a recommendation, but not mentioned again. Using capital to fund and give into trust. If you've got in a married couple either an age difference or where there's significant gains and perhaps one is not in good health, the transferring of the assets into the name of the person that has less longevity means that when they die, the CGT is wiped out on death. If on death, that person then gives to their surviving spouse, the surviving spouse inherits at that new value at probate. So there's lots of measures that you can use around CGT, which are quite clever and quite simple. Inheritance tax, as I put here, the 325 has been frozen since 2009-10. Yes, we've had the residential nil rate ban come in, which I'll deal with. And again, I always mention 10% of your wealth to charity takes 10% off your inheritance tax liability from 40% down to 36%. Yes, the residential nil rate ban has come in if you are giving to descendants, direct descendants, and if your estate is under £2 million. So that means if your family, if you're married or in a civil partnership and you have children and your estate is under 2 million, then your nil rate band is effectively £1 million. If you have no children or an estate over 2 million, then you're down to the 650. And basically, once you get over 2 million, for every £2 above, you lose £1 of the residence nil rate band. There's a significant sentiment of executors that don't know about this. So there is a danger if you don't get professional advice, they don't fill in the right boxes and they only get the 325. And of course, it can be carried over like the nil rate band till the death of the second one of you. So it's crucial that executors and surviving spouses keep the will and the probate and the details of the first to die to provide evidence of the unused allowance on second death. Now, I'm not going to go through a raft of inheritance tax issues here. That's a talk on its own. But what is clear is the level of numbers of estates now paying inheritance tax is going through the roof. Asset values at the moment with house prices and equity prices are higher than they've ever been. Most of you in this room will have more wealth in your name than you have ever had. And therefore, the burden of taxation, even when you look at the forecast on inheritance tax, is going up. So do look at that. We'll talk about timing and what's going on in the world as well. But this is probably one of our biggest areas where people are asking questions. I've touched on corporation tax. The green bond from NS&I was launched a week or so ago. Avoid it like the plague unless, well, I'm sure you can do lots of other green things. I'm not being dismissive of green things. I'm dismissive of the rate of interest. You can get with people like Aldermore and Paragon 1.4%. You can get with the Leeds, the local building society, 1.15% for a 3-year fixed rate bond. So if it is tying up your money for 3 years at a lousy rate of interest, the green bond isn't really the place for it to go. And maybe the last thing, the triple lock. If a triple lock had worked this year, every pensioner's pay rise would have been 8.3%. And it obviously the triple lock was linked to getting the highest for state pensions out of the 2.5%, CPI inflation, or the average earnings index. And because earnings went down so heavily 12 months ago when furlough came in and people were off work, the base dropped. And therefore, a year on, it looks astronomical. And actually, with very little opposition, the triple lock has gone for this year, and it's a double lock. So you are getting a 3.1% increase in state pensions for those of that age. For people retired post 2016, that's £179 to about 185. For those pre-16 state pension, 137 to 141. So a 3.1%. We don't know yet whether the triple lock will reappear, but we'll obviously brief you about that next year. So in conclusion, before I hand on to Luke, Luke and I are definitely going to talk about inflation, so I won't dwell on that too much. But as I said, the tax burden is at its highest since the 1950s. We'll talk about base rates. There is a significant school of thought, but by this time next week, when the Bank of England meets next Thursday, the 4th of November, base rates may rise. The consensus is by 0.15% from 0.1 to 0.25. But we are likely to see base rate rises. About 4 or 5 banks increased their fixed rate mortgage rates yesterday. So this is coming down the road. Fiscal drag means although you may be earning more from your pensions and although you appear to not be paying more tax, you are, and the tax burden will get greater. Your inheritance tax thresholds, your CGT thresholds are frozen. And so that the amount of tax you, your capital and your wealth on death will pay is likely to go up. So do seek advice, and no huge changes, but all the key areas that you need to look at remain as they are. Right, without any further ado, I'll pass you on to Luke, all the way from Bedale, delighted, not a jockey, but knows lots of them around there, who's been of great help to me over the last 5 or so years.
Hello, everyone. The past couple of years have been uncertain. It's a bit of an understatement. It's been very unique what we've all been through, and the impact it's had on investment markets has been equally profound. And what I'm going to try and do is chat about some of the major aspects that have had a bearing on markets over the past couple of years, and what we're likely to see or we may see going forwards from here. Now, this is a quote from Benjamin Graham. Benjamin Graham was Warren Buffett's mentor. He is widely known as the father of value investing. I suspect at the moment he's probably turning in his grave a little bit if he's been looking at what markets have been doing over the past couple of years. But what he's saying here is that the timing of markets is impossible. And to a degree, he is right. What our job to do is, well, Richard's job is to try and make sure that your objectives are being met. So your financial goals are being met, you're achieving what you want to do. Our job from an investment side of things is to do the research, to do the due diligence in the background, to try and ensure that these are the most likely outcomes, depending on what scenario plays out. So that's how we fit in. Why is market timing so difficult? Because of emotions. This is a chart that's really worth remembering. What it's showing is that people tend to invest when they are feeling exuberant. They have euphoria about things. Everything is rosy. And that's when you want to go and invest because everything seems wonderful. Really, when you should be investing is when everything is looking pretty doom and gloomy. And that's difficult to do. Psychologically, it's not what our brains are programmed to do. But in reality, it does play out. This chart here is showing investment markets going back over the past 2 years. So a little bit before COVID, you can see March of 2019, and all investment markets fell. It was shocking. It was the start of something that we'd never experienced before, going into lockdowns and civil liberties being taken away. We're all stuck at home. You can see, though, that what happened is that markets recovered very, very quickly. There were some people who sold out in March 2019, 2020, and they have missed out on all of the upside that's happened. And the black line at the top is the S&P 500, probably the most important market in the world, definitely the most important market from an American perspective. And you can see quite how strong the growth has been across the board, but particularly in America. Here in the UK, the FTSE All-Share is in blue, and the MSCI World, excluding the US, is the line in red. So why did America do quite so well? Well, one bit that I would probably say is that they did something unprecedented. They handed out helicopter money. Helicopter money is effectively giving people free money. It's terrifying if you think about it, but that's what they did. But also America has some very innovative companies. So there was an acronym which will now disappear, but it was called FANG. The reason that it's gone is that Facebook has just gone and changed its name. But Facebook, Amazon, Apple, Netflix, Google, these are all companies that you will have heard of. Amazon, from my perspective, delivered about 4 or 5 times a day throughout lockdown. I've got 4 young children. Everyone seems to have access to Amazon. Therefore, everything gets delivered. But these companies were able to keep on trading. Lockdowns didn't impact them whatsoever. And these companies did incredibly well and helped drive the American market over the past couple of years. If I was lucky, I could just talk about what's happened in the past. Unfortunately, what I've got to try and do is make a prediction about what's likely to happen going forwards. And there are a couple of key drivers. So COVID, I've got to chat about, unfortunately. I would love to ignore it, but we do need to chat about it a little bit. Central banks and government support, inflation, valuations, and possibly China those are likely to be the main drivers as we see things that are going to influence investment markets over the next year or so. So from a COVID perspective, the world has been in a pandemic. I think we are now moving into an endemic, i.e. something that we will live with. Some of the people in this room still have masks. We know that COVID hasn't disappeared. From a UK perspective, a lot of people have been double jabbed. A lot of older people have now been triple jabbed. I think jabbing is going to remain commonplace. We saw last night the lifting of, or the announcement of the lifting of red travel bans. So it is an attempt to try and get back to some form of normality. One of the nice bits that seems to be the case is that not as many people are dying from COVID, thank God. Around the world, again, it waxes and wanes a little bit. At the moment, Eastern Europe seems to be being hit particularly badly from a COVID perspective, but America is doing okay. Here in the UK, we're doing okay. This is not probably going to disappear at any time in the near future, but we're managing to get back into a room together. Some semblance of normality is returning. From an investment perspective, companies have been impacted in some ways the way that you might expect them to. This is a chart of Zoom. Many of you probably used Zoom during lockdown. Most of you, probably all of us, had never even heard of Zoom before COVID. But it became a lifeblood for a lot of people. Even my mother, who is 85, seemed to figure out how to use Zoom because it was a means of communication. It's not going to disappear. So we were chatting about this earlier on today. There will be meetings that will be held still through Zoom. We love doing meetings like this. It's by far and away our favorite way of doing things, but certain aspects can be covered through video conferences. From a share price perspective, you can see the almighty spike in the share price once everyone started to know about Zoom. Valuations got a little bit ahead of themselves and the share price has fallen back justifiably. I suspect it won't go back to the lows that it was once at because I think Zoom is going to play a part in our lives, but it did fall back a little bit. On the converse side of that, Wizz Air. So Wizz Air are a European airline. Airlines obviously stopped any form of business because of COVID. We've seen a gradual recovery, so there are more flights that are happening. Some of the people in this room will have gone traveling over the summer, but probably not to the same lengths that we did in the past. There's a certain amount of confusion about where we are going from here. So we've seen the initial euphoria once lockdowns were lifted, share prices rallying. We're sort of getting back to the level that the shares were at prior to COVID, which is probably appropriate. Now, central banks and government support. We're all well aware of the furlough scheme. Some of the measures that were happening as a result of COVID were unprecedented. Money was definitely thrown at the situation, which you could say caused one of the shortest recessions in history. Maybe a recession was even cancelled. It just didn't happen because of that government support and the central bank support that happened as well. And stimulus packages around the world were phenomenal. The Americans were probably the ones who threw the most amount of cash at the situation. And I know that Richard is going to give you a number in a minute about quite how much each individual received in America. But it was very significant. Now, when you are handing out free money to people, some people will squirrel that money away, and some people undoubtedly did. Some people will go and spend that money. Now, it's difficult. If you do not have the ability to go to the shops, or you don't have the ability to gamble because sports matches, et cetera, were cancelled, a lot of that money found its way into stock markets. And we're still seeing that today with some investors going over the top in their approach to investing. They've lost all rational sense to things and they are getting awfully excited about it. But from a balance sheet perspective, this is a problem that is going to be with us for an awfully long time. This is a chart, or the chart here is the United States central bank balance sheet. Down the right-hand side, though, just to try and put some bits into perspective. So the ECB and the Federal Reserve have added $7 trillion to their combined balance sheets in just over a year and a half. Post the financial crisis, they added 6.5 trillion. So they've added more in the 17 months since the start of COVID than in the 10 years following the great financial crisis. It is very, very profound. The amount of money that has been injected into economies is one of the reasons stock markets have done so well. Now, one of the questions that we face going forwards from here is what's going to happen. We already know that Canada have announced that they're not going to taper. They're going to stop their asset purchase liquidity programs. And in America, they've announced that they are going to be tapering the amount of money that they're putting in. Now, the cynic in me would turn around and say, well, it just means that they're not putting quite as much petrol onto the fire. They're not actually trying to put it out. But it has been incredibly supportive for investment markets. As that liquidity is taken away, the impact could be significant from an investment perspective. Now, inflation. We are all aware of inflation. Inflation was likely to happen, partly because of the money that has been injected into economies. But secondly, there are two reasons. So you commonly get inflation for either supply reasons or demand reasons. Now, supply disruptions we're all well aware of. Containers have been stuck on the wrong side of the world. Companies have been shut down, so they haven't been able to produce goods. From a demand side of things, demand has been strong. So a lot of people haven't been able to go away traveling, so they've got cash sitting in their bank accounts. They want to go and spend it. My wife, during lockdown, got into wild swimming. She would have paid an absolute earth for a new wetsuit. You couldn't get hold of the wetsuit because of the supply disruptions, but she desperately wanted a new wetsuit. There are so many different examples of this. Used car prices have gone through the roof. Why have used prices gone up so much? Because you can't get a new car at the moment because there are chip shortages. I've got to be very careful saying that one. That nearly went very badly wrong. So we are all aware that inflation is with us. Now, meanwhile, we've had central banks and governments turning around and saying that this inflation is going to be transitory. Now, transitory can open up a whole different topic, but effectively they're trying to say that inflation is going to be short term. They're slowly backtracking on that a little bit. And it's going to be interesting to see what happens over the next year towards inflation. Now, why have they been saying that inflation is going to be transitory? The main reason really is interest rates. Well, it's a combination of interest rates and debt. So as Richard was saying a second ago, interest rates are at the lowest level that they've been in any of our lifetimes. We have the possibility of a small increase in interest rates, possibly soon. But it is going to be a very, very small amount. We are not going to be talking about interest rates going back to the 18% or so that they were back in the 1970s. So the inflation forecast, so they say that it is going to be transitory, and the reason that they haven't increased interest rates is because they say that this inflation is going to wash away. The problem that they face is the huge amount of debt. So going back to this slide again. Now, you were all astute enough to be able to know the big, and Rishi mentioned this in the budget the other day. The big problem is that if they have to raise interest rates, that as a result means that they are paying a great amount of interest. And the problem is that if you're paying interest, you're not paying money to nurses, to doctors, to firemen, to any of these sort of people. You're not improving the roads, all of which are things that people vote on. You're giving money away just purely in interest rate payments. So they have to keep interest rates low. There is another argument that turns around and says the best way of dealing with debt is to inflate debt away. So there are really three ways, I think, that you can deal with debt. One is that you can repay it. The levels of debt here are far too large to be able to repay. And we know what happened when they raised taxes at the end of the great financial crisis, and the UK suffered because we tried to be prudent and we tried to repay our debts. So you can't repay the debt. let us hope we don't take the South American approach, which is to default on debt. So we'll write that one off as well. The best way of dealing with debt is to inflate that debt away. And if you can have inflation that is higher than interest rates, you will end up doing so. So over the past year, let's say, inflation in America has been somewhere around 5%. As a result, their value of debt has got 5% smaller. Some of you people would have bought houses back in the 1970s, and you thought yourselves incredibly clever, and you were, because you could buy a house for £10,000 and you sold it in 2000 for £200,000. Now, part of that was because you were very clever, but part of that was equally because of inflation. And the inverse happens with cash in the bank. So your cash that you're holding on to have enough for a rainy day, but if you're holding too much, the value of that cash will disappear. So valuations. People have put money into the stock market. I said a second ago that some of that was down to people gambling, some of that down to people having free money, etc. Part of that is also an inflation hedge. So one hopes that company earnings will keep pace with inflation. And if you invest in the right companies that have quality products, that have strong moats, so the ability to defend their market share, then they will do well in an inflationary environment. But equities have become quite expensive. This chart is going back to July, but it won't be wildly different. You can see that America in particular stands out as being historically very expensive. I said that some of that was down to the fact that it has some very good companies there, some of the most innovative, some of the most fast growing, and that is a real asset for America. But one needs to be mindful of valuations. Microsoft in 2000, just before the tech boom, it was still a great company. The share price took 17 years to get back to its starting point of the prior to the tech sell-off that happened. Here in the UK, we're massively unloved. Ever since Brexit, people haven't been investing in a global perspective into the UK. Is that going to change? I don't know. But if we get inflation coming, we have a lot of banks, we have a lot of oil companies, and we have a lot of miners here in the UK, all of which are likely to benefit. Benjamin Graham, who I was chatting about at the outset, was a value investor, as is Warren Buffett. The UK market could be said to be a value market, a value area to be investing in. Your multiples are not as expensive when you go and purchase in the UK at the moment. And it's probably a case of trying to get the balance right between having some fast-growing, innovative companies and some that are looking more attractively valued. And that's what our job is to do. Now, from a seasonal perspective, a lot of you may well have just received quarterly valuations. There is an old adage of sell in May and come back on St. Leger's Day, and historically it does pay out. This chart here, the red line is actually where we are this year. We had a strong start to the year. Part of that was down to vaccinations, the unlocking of countries and companies. We've had a little bit of a flat summer. Some of that has been down to confusion over COVID. And hopefully what we're going to see now, to use an American phrase, is a Santa rally, a strong lead up to the end of the year. I have no idea whether that will play out, but historically that has been what has happened. Now, the final bit that I put down at the bottom, so those are the four main bits. The other aspect that could have a bearing on everything is China, and it would be rude of me not to mention China at all whilst I am here. The headline that is dominating at the moment is China Evergrande, who are a socking great property company in simple terms. And for many years, it has been known that Chinese property companies have been over-leveraged. And by that, I mean that they're carrying too much debt. And China Evergrande is just another example of that. Is China Evergrande going to go to the wall? I don't know. What I suspect is more likely to happen is that the Chinese government will bail out China Evergrande to a degree. They want to make sure that people get their houses, so those people who have bought houses will receive those houses. What Xi has definitely not wanted, and he has been tightening up on, is entrepreneurs making too much money for themselves. And we've seen more of a, if I said, a communist approach to things in China. I think that's probably the best way of looking at things. So he wants China in totality to benefit as opposed to just a few wealthy individuals. Now, the troubles that are happening in China, a lot of those have been instigated by the state and are under the state's control. And therefore, I do not believe that there is going to be a huge upset that will not be controllable by the state. But it will be interesting to watch. Some of the steps that have been introduced have actually been quite interesting. So they have limited the amount of hours that young people can play on computer games. Now, I said a second ago, I have 4 children, 2 of whom, boys, spend a lot of time on Xboxes and things. If they were restricted to the 3 hours that they're allowed in China, I think that that would be a huge benefit, but I'm not allowed to introduce that. Just as to wrap things up from my side of things, there is always noise out there from an investment perspective. I always have something that I can be chatting about. Probably my biggest problem that I face is, unlike 20 years ago when I started this career, I had limited news. It was difficult to find news. Our problem today is that we have far too much news. I have 2 telephones and a computer over there. They all go pinging at me, giving some form of news. What's important to do is to sort the wheat from the chaff. So I want to stick with the wheat and I want to get rid of the chaff. From a market perspective, you can see this. It's a FTSE All Share. And you can see that, yes, there have been bumps along the way, but the general trend has been upwards. And it's managing within those general trends. But the bit that's most of it important of all is that ongoing review that you have with Richard, where you're discussing your own personal financial circumstances to make sure that the investments are doing what they should do to meet your objectives. And that's the key bit. That's it. Thanks, guys.
There you go. Ban your PlayStations or whatever. Only 3 hours on your telephones or whatever. And Mr. Amazon wouldn't appear so much around your houses, would he? Whoever Mr. Amazon is. Right. I sort of thought long and hard about what I do for the sort of normal penultimate or the last part of this. And quite often it's quite detailed about financial things going on and everything else. But linking to Luke, what I intend to do is share some of the excellent commentary that we get from the great and the good through St. James's Place. Where we are now allows us to, and particularly with lockdowns on Zoom and Microsoft Teams, we've had some excellent speakers from a wide range, from medical to journalism to obviously economics and finance. And what I'm going to attempt to do is, in a way, summarize the very strange period we've been through, but not overdwell on that, but highlight how really weird it has been. Confirm there's nothing wrong with thinking life is incredibly uncertain at the moment. I call it peak uncertainty, but not to panic about that. And I think particularly one thing we've not spoken about is the media. The media are responsible for the petrol crisis. You know, there is no doubt about it. It was not reported the way it should have been, and it led to a petrol crisis. And by then doing that, what I'm going to go through is 10 themes that you may want to just log down in your mind. Not saying it's good or bad, but perhaps are coming through already loud and clear in this current decade, and we're likely to see going forward. And if that just helps position a few things for you, and allows discussion with John and I at various times, or with your family and friends, I hope it achieves its goal. So we started with what Luke said, you know, just this incredible time. I never got my £5 for eating out in August of last year. We just never got around to it. But you know, you may tell your grandchildren at some stage, or your great-grandchildren, you were paid by the government to go to a pub or a restaurant. I mean, how remarkable was that? And then obviously, and it has, led to the prosperity we see by the government paying people not to work. It's not about whether it's right or wrong, but we have been able to get through something none of us have ever seen. and not seen unemployment going to the levels that many predicted at the spring of 2020. And we stand here today, as I say, every statement I'm doing for clients where I'm analysing their overall wealth, where we're still remaining cautious about the value of property because it's obviously only worth what you sell it for, but the evidence, a client just yesterday in North Leeds in Wheatwood, they went to sealed bids. There were 10 sealed bids, and the confirmed price eventually was £100,000 over the asking price. So this is a sort of crazy world we're in. And Luke mentioned it about America. This sort of highlights to me what happened in America. And that is that if your joint incomes have been under $160,000, just over sort of £110,000, you've received, and you've got children, you've received an average of $11,400 in the last 18 months. And that's actual money, actual money. And then whether it's good or bad, the fact remains that a lot of it hasn't been spent. People have been worried. They've been uncertain, just like you, just like I. It was one of the benefits, wasn't it? That first credit card that came in April or May of 2020. It was like your first ever one, maybe one tank of petrol, but very little else unless Mr. Amazon sneaked on there. And then we just had this incredibly different type of recovery. That was a recession. There were two severe periods of negative GDP. But then equally, what's happened in 2021? A huge response. Demand very significant. All that money that hasn't been spent, people are still acting cautiously, but people remain in a job. They've still got money in their pocket. They may have cut some costs in some way. The holiday bills, and many of you got rebates from the holidays that were cancelled last year. So you've got that coming in, and you've been cautious about spending money on the next holiday. So other spending, it's much closer to home now. People are spending money in their homes. They're changing the layout of their homes. They're spending it around there. And that's led, as Luke said, to the supply issues that we have been talking about, because factories have been shut. We'll talk about supply and labor in a minute. And therefore, it is difficult to get all sorts of goods. Chip crisis, so you can't buy new cars, etc., etc. And the shipping containers are the new way of judging one of those issues. So in October 2020, the average 40-foot container coming out of China heading across to Los Angeles, that sort of area, was about $2,500. It is in the last month, 9,864 on average, 280% up. Now we'll link this to inflation, but there are boats sitting outside European and American ports that you'll have seen in the papers. There's very little going back towards Asia, by the way, and clearly there is now, just in October 2021, the same sort of demand for airplane freight as there was at the start of the pandemic in March and April 2020, and with it the cost going up. So things that we just are not used to. I think the phrase that we've got used to is it's a just-in-time economy. Shops, manufacturers don't carry lots of stores because it all arrives just in time. That's been ripped up. It's now called just in case. And it will lead to countries around the world bringing a degree of manufacturing back. And we'll talk about, again, Asia and China, and again, trying to take control of their own supply systems. Is this a permanent thing? Is it transitionary? We don't know. It's just different, and it's unusual from what we've previously seen in recoveries. And thankfully, we're not talking about COVID too much, but it hasn't gone away, and it's not going to go away. And life has to work its way through with COVID remaining. But it mutates, and it's going to mutate. COVID is a really clever thing. When we've had some of our scientists and some of our medical people, how COVID develops is really quite worrying. But what we should do is praise our scientists around the world who've done an incredible job to get that vaccine. They call it Pfizer Day, Vaccine Day, in November of 2020, which then sent the stock markets and most of us feeling quite euphoric. And then in Britain, particularly, almost leading the way with the speed that they got the vaccine out last year. And then lastly, obviously, not only coming through that, we've seen what Luke's talked about and I'll refer to later. So it is peak uncertainty. And what's very interesting on a personal basis, when I'm conducting reviews, in some cases with people I've known over 30 years, sometimes much less, is clearly every year there's decisions you've got to make. Forget just about minimizing tax, maximizing growth. But how much money do you need? What are you going to spend? How are your children? What do you want to do? What's the world going to look like? And I inevitably come to a feeling as I'm discussing all of these individual issues with you, it's just not a good time to make big decisions. How can you make the really right decision when you've got all of this uncertainty? And it's not a bad thing. It's just accepting that it's an uncertain time. I wrote down just some things. Will we go into lockdown this winter? I have no idea. I hope and pray we don't, but we may do. What will Christmas look like? We all remember last year it was cancelled 2 or 3 days before. How will that look out? And clearly it did, for those that carried on with Christmas, lead to quite a spike. But that was before people had 2 vaccines or even 1 vaccine or a booster. What's air travel going to be like? I won't ask you to do a quick survey. I'd be really interested to know how many have gone on a plane and how many will go on a plane. That's just an interesting question. It's a very personal question. But that's, again, what will the new normal look like? Petrol, just fuel, the supply of it. Shops, empty shelves, lorry drivers, where have they all gone? Brexit, we don't hear much about it, but it's around there. And that's before we get to your normal questions about what will base rates do, which we've talked about with Luke, what's inflation going to do, and what's the market going to do. So I raise this and leave this for you to dwell on. It's okay to feel a bit anxious and a bit uncertain. I think we will move to times of greater certainty and an idea of what this new normal looks like. But it is a very, very strange time. And so I've obviously got to forecast what's going to happen. So you've all seen that. 2 great types of forecasters, one that don't know, and more worryingly, those that don't know, they don't know. So anyone that's really clear, and just a point, you're seeing more commentators saying we're ready for a stock market crash. I'm very cynical. I keep these articles now. And if you say there's going to be a stock market crash each of the last 10 years, you'll get one right. The fact the markets may have doubled or tripled before you predicted it is a different thing. So you're always going to pick predictions. The former MP briefly for Harrogate, Norman Lamont, is famous in his speeches. He says this: you will soon be the most unpopular man in the country. And that's what the Chief Secretary to the Treasury said to him when he became Chancellor. Do you remember the ERM crisis and putting base rates up twice in a day in November 1990? Here's Lamont's response to that when he resigned. In all my years as Chancellor, that was the only forecast the Treasury got right, i.e. that he was going to be unpopular. So we're not going to forecast. We're not going to do that. We're going to look at the themes. And I'm not going to overdwell on the first because Luke's covered it really nicely. Is it transitionary, this inflation, or is it a more permanent feature? At the moment, there's evidence that wage inflation, once we take out the lows from last year, isn't under huge pressure, but that could well change. And that could be one of the issues if the unions get going and people start rebelling a little bit more as this tax takes go up. If wage inflation becomes more endemic, possibly we could see more permanence to inflation. What is clear, because of the way inflation works out, is we are unlikely to get the spike in energy prices this time next year. And when you take that spike out, that will lead to a lower movement. So there is going to be, in a year's time, some downward pressure. We don't know about where the upward pressures will come from, particularly wages. Inflation is predicted to continue to rise up to about April, and we're talking CPI possibly even hitting 5%. For people in retirement, my mother and many others would argue, who spend more, say, on fuel, even if it's heating fuel, more on food, and more on things like council tax, it is commonly accepted those levels of inflation are higher, and that's before you start to get to any form of care or help. Again, just as my mother's coming this afternoon, so I can say all these things to you, but not this afternoon. She's quite rightly just put her cleaners rates up by about 25%. Frankly, should have done it a couple of years ago. But she's got messages that the cleaner, obviously, who's invaluable, is getting better rates elsewhere. Everyone needs reliability. We are all going to have to pay a little bit more for it. That is one of the effects. Some, we'll come to it later, higher wages, particularly at the lower end, isn't necessarily a bad thing. I'm intrigued by labour shortages, because why didn't we know about labour shortages a year ago? What's suddenly going on? And I read up quite a bit on this and listened to what people have said. And what's clear is, as we went into the pandemic, many people didn't then come back. Many people said, I like my life at home. We've actually got enough. Why am I doing all this? So the labour force has dropped around the world. And this is not just a UK issue. This is not just a Brexit issue. That is way too simple. In America, McDonald's are paying $100 signing on fee for workers to work in their McDonald's restaurants. The other thing that is clear is that around the world, a lot of the migrant population who were typically on lower wages, when the pandemic struck, what do? You go home. And we've seen that in the UK, particularly with a lot of people from East Europe perhaps going home, and either they haven't felt welcome to come back to Britain with the post-Brexit view, or they just haven't come back. So we do have around the world labour shortages, which are beginning to iron out, but it isn't likely to change overnight. And that leads me to wages. I think we may look back and say the last 20 years were an exception, where really wages were held down quite strongly. Companies didn't have to invest. Labour prices didn't go up much. The low paid were paid low rates. And one of the realities, and Boris is pushing this very clearly, is we need to pay more wages, particularly if we want British workers to stay in Britain and do some of the jobs perhaps that were done by East European or other workers. And there's another factor to that. Chinese labour is nowhere near as cheap as it was before. So just as you will remember when you first bought cheap goods, they were made in Taiwan. They may be made in Japan or Hong Kong or Vietnam. It moves around where cheap labour is. And we may be starting to say that labour is no longer so cheap in China. China has recognized this and has tried to install in its own economy huge internal demand for products, so they're less export driven. And so they've recognized it, and it will be an impact that maybe all of you will have to see. If you want help as you get older and you go and you have to pay for it, I don't know what hourly rate you would think. Have in your mind what it would take for 1 hour of care. And that's not to dress or clean or whatever. It could just be generally helping you. It's currently, my mother is paying for 2 hours for assisted shopping. She still drives just to help because she's got osteoporosis. I will cut a lot of this out this afternoon. That rate, have you got a figure in your mind? It's £36 an hour, just to give you an idea. And care and getting employment in care and the wages that carers get, when you look at the other side of it, has been really quite disastrously low. How can you expect good help when you pay very low wages? Innovation and investment. That has been one of the benefits of lockdown. If I'd ever thought that my staff would work just as well without having to come to the office and I can monitor them, I wouldn't have believed it. And everywhere we've seen people have learned from this. We can actually improve some of the conditions for people at work, and we can innovate incredibly well. There are now driverless taxis in Arizona. I'll give you an example of innovation in London from personal experience just a couple of weeks ago in a second. The amount of times you now may do a faster payment. This is my retired clients now. They don't give me checks. They don't want to give me checks. They are happy to do a faster payment with a bank. There are so many examples. Mr. Amazon, whoever he is in a white van appearing all the time, is another example of the way things are going. And this pace of change, we believe, is not going to slow down. And I'm not going to overdwell. I'm not a scientist at all, but from having a car that can drive just about 17 miles and is called a hybrid before it runs out 5 years ago, you've got cars now clearly that can drive hundreds of miles and are not hybrids anymore. There's infrastructure issues about how you're going to recharge, the nature of change in how you heat your house, and technology around batteries is really quite astonishing. And again, we've had whole sessions from scientists just describing the pace of change going into there, and with it, the supply problems that you have in making every battery. Unbelievable change that's going on. And the budget yesterday really summed up what we call big government. Boris is big government, let's be clear, the interventionist state. He and Maggie Thatcher may be for the same party, but they are light years apart in their philosophies. And it could have been Tony Blair or Brown standing up for a lot of the messages we've heard in the law. And I'm not trying to be political there. I'm trying to say where they're coming from. So we have infrastructure spending that's changing. We've seen, obviously, childcare, skills, leveling up. This whole thing of leveling up, which I don't really understand too much, apart from the North apparently going to get a little bit more help. And of course, the massive one is the health and care and welfare. And the unbelievable amount of money that is already going there, and with the health and social care levy that I started with, that extra boost that's going into that. Very different. Big government is here. It's had an excuse with the pandemic to save the world, and it's going to stay like this, certainly, we think, for the decade. We don't see any reason why that will change. So quite a different philosophy. And I mentioned to you, spending is at the highest percentage of GDP since the 1970s already, despite the debt that Luke referred to earlier on. Tax rises, I don't need to say a great deal. Yes, Russia doesn't, we suspect, quite like the interventionist way of Boris, but he's going along with it at the moment. And clearly he wants to be the savior to probably get to an electorate that's beginning to get a little bit fed up with the higher taxes pre-election 24-23, with some sort of cut that I referred to earlier. But certainly your children and you are going to feel the pinch of taxation one way or the other. But with that NI rise that I referred to, from 1 in 26 to 1 in 9 being higher rate taxpayers by 26, more and more people of working age are going to feel the pinch of paying that high level of tax. And then the last three I'll lump together, again, in a very generic and overview. The political world is obviously changing. Where Russia was in the Iron Curtain days, the 50s and the 60s, and the strength of Russia compared to where China is now, at the start of potentially a new Cold War, again, are light years apart. We've referred to President Xi's communist stance. I mean, the IPO, you may remember last year, of Ant Group, Jack Ma from Alibaba, he disappeared. You know, this is like Mark Zuckerberg being taken away by the American government. He didn't appear for a long period of time. The power of the Chinese government, the communist influence, the redistribution of wealth is a dominant force and will affect the world. What does or doesn't happen to Taiwan? My father would be very interested in that if he were here. And it's not the normal historic Chinese way to be very front foot aggressive, but Taiwan is an obvious space of worry and could clearly be a flashpoint dependent on what someone like Biden and America did or didn't do if that flared up and became a rather difficult area. East Asia has been the beneficiary of the pandemic. It dealt with COVID much quicker. There's still the mutations and everything else. But when I talked about shipping forecasts and shipping costs, those were the costs coming out of Asia to America and Europe. For every $9,000 container coming that way, it's about 1,000 going the other way. Just gives you an idea of where trade is coming from and to, and the power that goes there. And on a positive, politically, we've been starting to see the UK possibly doing quite a clever thing and pivoting to an area in the world because of Brexit and because of need that could be a beneficiary of the next decade. So we've seen deals done with our Commonwealth partners in Australia and New Zealand. We've seen we know what the government is trying to do with East Asia, and there may be beneficiaries by us being the first mover and by us being an island outside Europe in how we deal and start to increase trade over there. So that may be an opportunity that's coming through. So just some general themes, which you will hear. Again, Luke, I think, summed it up. There is so much noise, isn't there? Some terrible reporting. But underneath it, there are themes appearing, which I think one's got to take note of. And what action do you need to take? There's nothing too revolutionary here. Clearly, the old adage of having enough money so you can sleep at night remains completely solid. I think, frankly, if I had to pay to have money in the bank for that, I would do. And we're hardly getting any interest. Again, is it 3 months of expenditure? Is it 3 years worth of expenditure? Let's talk about it. Some of our clients undoubtedly have been carrying excess levels of cash, which have gone up because they haven't spent their income as we went into the recession and have come out. So look at that, because inflation at 3.1 today, base rates at 0.1, you're losing quite a bit each year, and that will have a very damaging effect. I don't want to go on about inflation anymore. You are old enough to remember the 70s and 80s and the damaging. Your children aren't, and perhaps they need to be reminded. The tax burden we've talked about, the pace of change is unlikely to slow. So I told you about London. I was in Clapham at 10 o'clock at night with my wife, my middle son, and his girlfriend. He decided he was buying a sofa. Done it all on the internet. It was a place that was less than a mile away, or so he thought. Went and picked up this sofa. Clearly, it's a bit heavier than he had expected. We'd probably had a little sherbet or two over dinner, and the quick journey to take it wasn't going very well. And there was a sit-down protest from my wife in Clapham High Street on this sofa. Within 15 minutes, he had loaded onto his phone Zipcar, which allowed him to register, apply, find out where the nearest van or car was to the location. And he could, if we'd gone further, walk to it, put his phone against it, which would have opened it up, and we'd have hired the car for about £15. Of course, what he did do, or his more sensible girlfriend did, is just ring Uber or get Uber on an app or whatever you get Ubers from, and that appeared within about 15 seconds. But that just tells you, you and I hiring a car, it's a sort of mission. You start about a year before you go on holiday, and then you sweat at the airport, don't you, with your credit card and your driving license. That's just in one small way epitomizes the pace of change. Our technical director goes on and says it's fast, and it's only going to get faster as some of the developments in the pandemic have allowed it to go through. The burden of the public debt, the highest level of debt in peacetime, is almost glossed over, isn't it? It's not going to go away. Luke, I think, rightly feels and said they're hoping to inflate their way out of it. But the reality is that you paid for the Second World War debt. It was only paid off in 2008 by Ed Balls. And the reality is this debt, as a Western democratic society, is likely to be paid off, but it's going to be paid for by your working population and maybe your grandchildren or great-grandchildren who will come out of school. A higher national insurance, higher taxes in general, and it is a great burden. And that is an anchor to say to you, you are probably the last generation here, if I did a poll, that has final salary pensions. Most of you will still have them. In 10 years' time, you'll be in a minority. And if you are able and it feels right to help that next generation in whatever prudent way, I think it will be very much appreciated. COVID's not going away. It's just so wonderful to see you all getting on. It's nice, those at home, as I wave to a camera, which looks ridiculous, to see that you've adapted and you are watching us on YouTube. Who would have even, I think I've been on YouTube twice in my entire life. I don't think I'll go on and look at myself tonight either. So, COVID will stay here. And I think it's a really important point. How are you going to adapt? What do you want to see? I get agoraphobic clients, very positive. They quite like not going out. They quite like being in their gardens and nice houses and a simple life. They've traveled and worked hard. I get other clients that say, I've lost 2 winters now. I'm not going to be around that much longer, and I'm going for it. And I think, I think the answer is it'll be gradual. You'll keep trying things and see what you think, but your own attitude is important. And that really links now back to Luke. I think in all my time, never have I been as open to confirm its peak uncertainty. Never have I felt that having spread of wealth by asset class, property, equities, bonds, alternatives, commercial property, gold, even a bit of crypto, if any of you are real gamblers there, we'll leave that one out. And this just shows over the last 6 years, being America, as Luke has touched on, absolutely demolishing returns seen by, look at E, that's the UK. Look at the difference represented by the S&P 500 and the FTSE. You've then got Asia, emerging markets, and Europe in the middle. You've got the government. So that's history. What's happened this year is also interesting. America continuing to dominate, led as not by the FANGs, we're going to have to call them the MANGs now, aren't we, as Facebook's new name. But look at that. B is the FTSE 100. Second best area in the world if you just look at the generic areas. Luke touched on it. Why? Well, we've got a lot of miners, the things that they did us badly last year, a lot of commodities, the Shells, the RTZs, BHPs, BPs, Glencore, a lot of those in the indices which have done well this year. We don't have much technology, which is why it was so poor last year. You can see, interestingly, Asia and the emerging markets struggling. You've had higher incidence of COVID in places like Vietnam, factories shutting, more impact perhaps than what people felt. And safety. Blue at the bottom is safety. The FT All-Share Gilt Index. Government gilts down 7% this year. So the 10-year gilt yield was very low. The expectations of interest rates very low 12 months ago. They've gradually risen as the year's gone on in the expectation because of inflation that interest rates will be higher going forward. That loses value, that inverse relationship between the forecast of interest rates and the price. So safety in bonds. And those of you with significant areas of wealth in traditional government debt or corporate bonds possibly need to just be wary of that trend. And the final thing, bringing to St. James's Place before I sort of round up, I profusely apologise. We've kept the GPO, the Royal Mail, going single-handedly in 2021. The paperwork we do, you don't have to get it. You can ask for it to be online, but I like to get paper, so you've absolutely got that right. But there's a number of changes that have happened. Managers we've introduced, highly impressive group of managers from around the world. Most of the people I'm talking about there do not manage wealth in the UK. They are international managers. One of the advantages, which I'll end on about scale, is the ability for us to find managers who we really do like but are outside the UK. And there's more changes on the way in the alternatives area. Letters will be going out next month about a change of some of our alternatives funds into the global absolute return fund. And the need to monitor managers, as I've just said, the need for stock selection, the need to look at geographical diversification in this incredibly fast changing world. Wizz Air and Zoom, I thought from Luke, were great epitomes of just how much can change so quickly. The need for that expert advice now more than ever is crucial. And I just want to touch before I end on two recent reports from chief executives of British companies, because although there is much uncertainty and although there is much doubt, there are businesses into which we have put your wealth that I have absolute certainty are going to be here and will keep going and can be viewed somewhat as rather boring business. So I quote directly, "We are confident in our ability to take inflation in our stride whilst continuing to support our brands." Now, this particular company's brands include Johnny Walker, Tanqueray and Guinness. The first and the last for me, definitely the middle one for my wife. And that price keeps going up. You'll know who that company is. I don't need to name them, but I support the thesis that we will need the old liquor. If anything, the lockdown has taken people into premium brands, and they are paying more for specialist brands because they had time to look at all the gins and all that. And another, I quote directly from a chief executive in the last quarterly update just last week, "Supply chain disruption seems to be in the news daily, and we expect to be managing this for the balance of this year and into at least the first half of next year. But this company manages this type of volatility well, and our supply chain has again shown the necessary resilience to keep our on-shelf availability, the ultimate measure, at strong levels. Across our top 10 markets, on-shelf availability has been over 96% during the period, which is actually an improvement on the same period in 2020. And 80% of these companies' sales, their brands are either number one or number two in their markets. I'll give a little idea. Some of you at breakfast, if you don't like Marmite on your toast, will have Marmite on your toast. And this company does that as well as a plethora of things. So when you get down to it and Luke starts at looking at his job, I look at underneath the bonnet where our expert managers are going. I have utter confidence that in this decade I've just talked about, we will find our way through, but it won't be just picking something now that is fine in 10 years' time. It's being on the ball. There will be businesses that are not even born yet that could be dominant when I talk, say, in 10 years' time. So just to sum up before we go into question and answers, I think what I've tried to say is, although it is uncertain, our desire, our great joy, particularly for John and me, is to give you ongoing advice. We will be celebrating St. James's Place 30 years. It's not a long period of time, but I've been there since day one in the 2nd of January 1992. That will be a celebration, obviously, early 2022. We are now the 61st largest quoted company in the UK. And that's not a boast, but what does it mean? It means, and I'm absolutely passionate about this, that we have access now to a quality of managers who are not necessarily mainstream, but incredibly better at managing, more nimble-footed, looking at the world rather than the UK than, frankly, we ever had. When I think back to the early days of Torp Hodson, StoneX, M&G, and Scottish Amicable. That's what we started with in and we were revolutionary because we had 3 managers. We have the resources. An advantage of size is the resources that are available to John and I, both to make sure we remain literate and knowledgeable, but in getting experts around the field that can give us advice and give us expertise. And there's nothing better that I like saying to a client, "That's a great question. I don't know the answer, but I'm going to make sure I get it for you." And I flick an email to my tax and trust team, and then we'll send that back within days. So the resources we've got are, I think, market leading. And rather boringly, what we've also had to do after 25, now nearly 30 years, is we really do, and we spend a lot of money on our infrastructure in the back office, so our administration systems and the number of your accounts and things have changed beyond belief. But the one core thing that I enjoy is whatever senior person in the organization I speak to, they know that the core business is advising you, giving you direct and face-to-face, ironically, a wealth management advice. And that's not going to change. Whether we deliver it a bit more through YouTube and whether it's a little bit more hit and miss about the means by which we're doing it, giving people face-to-face advice is crucial. We reported last week a record ever third quarter because the demand for wealth management advice in the UK generically has continued to rise. So thank you from the bottom of my, John and Luke's heart for attending today. We're now, and I think we've got some time to do a Q&A. At the end of the Q&A, please stay seated. I've just got a couple of things to deal with there. And what we'll do with the Q&A, if you don't mind, it's one question per person as always, so that you make your question a good one, because you're not going to have a follow-up. It gives everyone else a chance. And we're not going to have microphones, which we normally do with people running around and hands transfer. So I will hopefully listen, or my colleagues will repeat your question, which also means viewers from home can hear it. And then I'll refer to my experts over there who will hopefully answer or help me. And if you haven't got any questions, we won't look at each other, but who's going to be brave and put the first question to us? Great. I think I recognize that person behind the mask.
Small headlines at the moment, but Poland has just been fined €1 million today. Whether or not they pay us, I don't know, of course. But if they come out, what is that going to do to Europe and scrutiny else?
So I'll repeat the question as far as I've got it, with the Poland being fined by the European Union €1 billion, €1 million. I'm not quite sure what the figure is. If Poland comes out of the European Union, what does that mean both for the European Union and for the UK? Was that a fair summary, Richard? Ooh. Looking at me, I'm looking at it. I firstly don't get a paper until Saturday and Sunday, and then overwhelming it. One of the things that many of our advisors said, Richard, when we left the European Union, was this is the start of the end for the European Union as we know it. And perhaps this is the continuation of that. Against that, again, what some of our European advisors say it is hard in Britain to understand the social, economic and political will that remains to keep the European together. So you've got a number of different views. And obviously Europe at the moment is in a bit of a vacuum. The French have got an election. The German leader is no longer the same leader for the last 20 odd years who's kept Europe together. So I think, again, the words peak uncertainty are probably hugely relevant. I'm not going to comment because I have no wise answer on what is likely to happen. I don't know if Luke or John want to add to anything I've said.
I probably wouldn't add anything different to that. It becomes rather political. I think that there was an argument, or there was a comment made when we were leaving Europe, that Europe either had to become more federalized or break up. And that, I suspect, may well still be the case. Which countries decide to stay or leave, I don't know. Europeans tend to feel more European than English people or the UK did when we were part of Europe. So that's as far as I would say. Personally, I don't know the finer detail towards Poland. It would be easy, as Richard said a few minutes ago, to find out a little bit more detail and happily provide it to you.
Thank you anyway, Richard. I'm sorry, I didn't recognize you with the mask, which will be a problem for many of us. Any other questions? Yes.
Yes, you haven't really covered much on the climate change situation. And I think that's a major event, whatever you like to call it, which is going to feature in the very near future in It's not something that's coming along in 10 years' time, it's here now.
Yeah.
And we need to start looking at the industry and things that are going to help.
Really good question. The question centered around the climate change issues, which we've not covered, and absolutely, we had a lot of debate about that. Just one point: you have all, or should have had, an invitation to a Zoom conference dealing specifically with this issue. And if you haven't got it, there should have been an email. Make sure you put on your feedback sheet, and we're going to deal with it specifically with some pretty high-powered people. From St James's Place's point of view, our Director of Investments is going to be in Glasgow. He is utterly passionate about it. And every one of our managers has had to sign up to a whole number of accords. On a personal level, I use BP and Shell to highlight my confusion. Should I not be buying BP and Shell because they're digging oil out of the ground? Or should I be buying BP and Shell because they're probably leading the investment into green technology, wind farms, and so much? And I don't know what the answer is to that. And I think there's as much social importance, boo-hoo, in the UK, in Leicester, employing people for ridiculous wages, as there is environmental as well. But it is huge. And I think indirectly, through your wealth, St James's Place are absolutely aware of the impact we can have on the decision-making process and what businesses have to do. And I think that the difficulty, and Luke may want to pick up on this, every major quoted business has now got a department or a head in this environmental space. Whether they're doing it for the right reasons or not is a point that I've got to be convinced about. But you are right. And the final point I would make is, even if people in this room are not fussed about it, or it's not number one agenda, let me be clear, everyone who's under the age of 40, when we deal with them, it's the number one question. It is the most important thing to them. Your grandchildren going through school will be, and I don't mean brainwashed negatively, will be full of knowledge about it. And so it is absolutely here, and it is here to stay. And as I say, if you want to hear something that will last about an hour exclusively on this area, please tick the box. You should have got the invitation, and it'll be well worth listening to, I think, in a couple of weeks. I have 9th or 10th on my mind as a date we're doing it. Luke?
I think it's the 10th.
10th of November. Anything else?
Carbon neutrality, a cleaner, greener world is going to be with us throughout all of our generation. It's something that thankfully we are thinking about, we being slightly older. Children and younger people are very, very conscious of it. It is a trend that's going to keep on playing out probably for the next 20, 30, 40 years. We've seen governments taking steps in the right direction. So Richard was talking about the green bonds being launched by the government. And here in the UK, I think Rishi said that we have issued more green bonds than any other nation in the world. There is still talk, there is more action that needs to happen, but it's definitely going to be at the forefront and something that we should be investing in. Your question, I wasn't too sure, was relating to carbon neutrality, a cleaner world, or specifically to COP26. COP26 so far, I think you could say, hasn't started quite the way that people would want, whereby China has not turned up and they haven't announced any changes, any new changes for COP26, which is a shame. Hopefully there will be some more positive news coming out from people attending the event, assuming that they can get there and the whole thing is not flooded or stuck with train strikes or anything else like that. But yes, it is hugely important, something that is very integral to the way that we manage money, and will be one of those macro trends that will play out for an awfully long time.
Thanks, Mr. Christie. And maybe time for one. Oh, right. I can see the character at the back who's quite well known to us, from Hutton Rugby.
May I thank you for this presentation. It is a long time since you've been there, but it really has been enlightening. It's absolutely a delight to be back here. And so thank you for that.
Thank you.
point was made about the energy, and you mentioned during your presentation about the Cold War developing. I think it's quite clear that we've invested a lot in relying on Russia to provide Europe with energy and then us with energy. I'm sorry, but I think we should become self-sufficient in energy, and we might have to make some hard decisions as to what that would be. We really can't be held to ransom. But the other thing that I'm concerned about is that I think this government has done pretty well over this last 2 years, which is what you related to. But maybe they're taking on too much, and you can't take on too much and deliver everything. And I would like to think that they concentrated on taking it forward over the next 5 to 10 years by being realistic, and that concerns me, because that has an effect on all our personal investments through St James's Place. That, to me, is the biggest threat we have.
Thanks, Andy. I've got to try and repeat that and summarise it, so forgive me. The whole thing of fuel importing and self-reliance, with particularly Putin seeming to dominate gas, is one part, if I can break that down, and then slightly interventionist government, sort of big government being a concern. Certainly, what you're alluding to on the fuel side, there are many commentators we hear that are in huge worries about our capacity and our storage levels being at where they are, and think policy has been irresponsible on that. You can argue the debate on nuclear energy, which is obviously an alternative, has been kicked into the long grass, so they're looking to make progress, I think, down in Sizewell. So you are right on all that. There is nothing to really add or say. And the worst thing has been, ironically, this summer, when we are a leader in wind energy, there's been no wind. So, we lead in an area, but it does rely on wind, which, today we've seen more of. In terms of interventionist government, again, I think you made that as a comment and an observation. I've got really nothing to add to that, which I haven't covered already. Again, I don't know if you want to talk about fuel or
the gas price side of things. Gazprom has fulfilled its obligations. So it did what it supplied the right amount of gas. The problem that came about was seasonally, the gas price falls over the summer, normally because it's warmer and everything else like that. So if you're going out and making a commitment to go and buy some gas, normally what you do is you wait until the summer because the price will be a bit lower, and then you buy it then. The problem that we faced this year was that the summer also marked the end of lockdowns. So as opposed to the price falling, the price rose. And therefore, those people who are in charge of buying gas for the whole country sat there thinking, what am I meant to do here? Because I'm trying to make a profit on things, and yet the price is going up. And they delayed, and then they had to buy it. And you end up with a classic short squeeze that has happened. Russia has met its obligations. Yes, you are right. We need to be more self-sufficient. I think self-sufficiency is going to be a trend that is going to play out in totality. So as opposed to being reliant on chips from Taiwan or lumber from Canada, we need to be supplying our own energy. We need to have innovation here within the country to make our own chips, our own timber, everything else like that. And I think that will be that's one of the wider trends that I think will play out, which Richard was alluding to, some of the problems that we've faced through last minute supply chain dependency, and we need to be doing more for ourselves. I think we'll see more investment into self-sufficient energy, which is likely to be green orientated. So we do have a huge number of windmills up. Having been to Scotland the other day, by God, there are a lot of them as you drive down the M6. It doesn't help when the wind doesn't blow. So it's trying to get that balance between nuclear, wind, wave, tidal, etc. We've been late to the party. one of the problems that there is politically is that politicians aren't in power for a huge length of time, and therefore do they have the commitment to be able to invest money into something that may take 10 years to actually come to fruition. It's one of those drawbacks. But yes, you're completely right.
Right, it's coming up to 12 minutes past time. I'm going to close questions there. You have feedback sheets, particularly that COP question. Please get your feedback sheet out. And if you could hand it in to the girls, any comments, any areas that you want to talk about, or anything that we've not mentioned that you do want to talk about. What I'm going to suggest, having been on Jet 2 a couple of weeks ago, they very neatly let everyone go off in rows. I'm not going to do that. But I would just say to you, be aware that normally everyone leaves at the same time and it can be a bit of a muddle. So you may just want to just take it easy for a bit. If you need to get off it straight away, get off straight away. I guess we'll stay at the front and slowly mingle back, but we'll stay here. And just as you all have been, be as careful perhaps leaving as you have coming. So wonderful to see you all here. Let's really, really hope we don't have any more lockdowns this winter. Most of all, you and your families stay